the chances are very high, in the 90% or above, that we'll have a liquidity crisis. In other words, when the credit markets freeze, and then they just dump everything, and that includes gold. It's just a huge surge or a lurch towards U.S. dollars. Everybody wants them, everybody needs them. So in that case, gold will sell off. But that'll only usher in the second leg, let's call it the second leg of a multi-year bull market in precious metals, in my opinion, as the Fed ushers in that long period of stagflation like we've never seen before.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He's an active money manager. He joins us this Tuesday, April 19th, 2022. Michael, thank you for coming back on Liberty and Finance.
Good to be with you, Dunnigan.
Our viewers look forward to your insights as an active money manager because unlike what they're hearing from any traditional, I don't even know if you can call it traditional, let's just say mainstream sources or some of the sort of corporate so-called financial planners that people can go to in their neighborhoods who tell them 60-40 stocks and bonds if you're under this age and 40-60 if you're over this age and just stay with it and ride out the dips and that sort of thing. You've warned us in the past that the game has changed. Assets are no longer anti-correlated to each other, so you don't really have diversification if you do that, and people are going to get wiped out if they don't take a more active role. If they don't feel qualified to do it personally, they should get somebody who is qualified. So could you, before we dive into some viewers' questions that have been submitted ahead of your arrival here, give us an update, because you've been warning us for some time now about signposts you're watching for and you're seeing sort of on this road to destruction of our capital markets and of our currency and of people's futures financially if they don't take preventative action. So can you tell us what the latest signposts are that you've been watching in the past month since we spoke with you that have confirmed or modified your assessment of where we're at in this process and the risk that people are currently facing?
So first of all, I'm not a perma bear. I've always been bearish, always meaning probably since 2007, 6, 7, of the construct of the economy. In other words, an economy that's built on the deformation of interest rates, the creation of asset bubbles, and the taking on of too much debt. That's the foundation built on sand, if you get the imagery there. The allegory. I think that's a good word. Not a perma bear. In fact, I was very bullish last year when we first started talking. I said that the economy was going to do okay and that stocks would go up, and they did. But then I started warning towards the middle of 21. Of course, I was bearish in the start of 2020. I'm just trying to, I'm an active manager, long short strategy. So sometimes I'm bullish, sometimes I'm bearish, and I'm always bullish and bearish in different things. But I did warn 2021 that this year was going to be a poop show, a poop parade. And the reason why I said that back then was because of a stock market that is at the all-time high of valuations. In fact, it's more than 40 percentage points higher than where it was compared to the tech bubble of March 2000.
And can you clarify for people, can you clarify, because they hear on the evening news every night, oh, new all-time high on this index or new all-time high. And that's not what you're talking about. You're talking about valuation compared to what? What's the way that you valuation?
I'm talking about the total. I'm talking about the best metric for measuring the value of the stock market, which is the value of the stock market, total market cap. All right. Shares outstanding times price, as a percentage of the underlying economy. It is one metric that you just can't fake by taking on a bunch of debt and buying back your shares and lowering the PE ratio. Price to sales is another metric that's hard to fake, also at a record high. So you're 40 percentage points higher than you were at the apex of March of 2000 for the NASDAQ bubble, right before it dropped by 83%, by the way. So that was predicate number one. Number two is you were coming off a massive fiscal stimuli, which was, as I say, $6 trillion, $50,000 to family. It just ended abruptly. Then you add to that inflation, which if you measured it correctly, would be close to 20%. We can quibble whether it's 15 or 20 or even 25. But if you look at all the most salient metrics of rent appreciation and home price appreciation, we talked a little bit about that in the pre-interview. Look at the cost of beef or the cost of energy. You're about 20% year over year, which is an all-time high in rate of inflation, which is destroying consumers' purchasing power. Then you add on to that spiking interest rates and spiking debt service costs on top of that. Then you add on to that a war in Russia, Ukraine, which is exacerbating the inflation and bottlenecks. Then the COVID-obsessed megalomaniac Chinese government, which is shutting down Shanghai and Shenzhen every time someone sneezes. And those are bottlenecks that are further exacerbating global growth to slow and inflation to stay higher than it normally would be. And then you add on top of that the most hawkish Federal Reserve since Paul Volcker. We have a Federal Reserve that got so far behind the curve, destroying the major constituency for the Democrats, who need to sort of save whatever they can, salvage the midterm elections in November. So you have a Federal Reserve that's absolutely going to trip over themselves in May, June, all the way through November to raise interest rates by 50 basis points and at the same time undergo quantitative tightening. Now, I'm not naive enough to think that the Fed is going to raise interest rates to 3.5% and drain the balance sheet from $9 trillion to $4 trillion. I'm not saying that. What I'm saying is they are going to be forced to aggressively fight inflation until something really breaks in the economy. In other words, until the credit markets freeze over. In other words, until the stock market goes down 30 to 50%. I don't want to, I'm an active manager. This is actually good news. It's good news. Well, Mr. Pento, why? As a Christian and as a supposedly trying to be a good person, why would you say that the stock market going down 30, 50% is good news? Because A, it's actually the healthy thing that the economy needs. You need to have stock prices come back to where the market can support them, not the money printing monkeys at the Federal Reserve. And you have to have home prices come down to a place that can be supported by the free market as well, so that first-time home buyers can afford a house. That's a reason why I'm very happy that this is it's in the process of happening. The bear market has begun. We're in the middle of it, or maybe even in the incipient stages of it, if you want to be exact. And the other reason, B, why I'm not so concerned about it is because I can actually, because I'm an active manager, seek to protect and profit from that grand reconciliation of asset prices.
Now, you mentioned in passing there real estate. So can we talk about the housing market? Because it's something we've come back to several times. A lot of people were basically locked down in their homes during the COVID period. A lot of people finally made their moves either to a bigger home or a different home or to a different jurisdiction, frankly, where they could get perhaps more freedom and that sort of thing after the COVID lockdowns were eased. And there was this huge spike in housing sales, housing prices, and so on. Some people have recommended, and you were among the voices expressing caution of people buying, quote unquote, at the top of this market and saying, look, housing prices are going to be affected together with equity and stock prices if we get a spike in interest rates, et cetera. What's your current outlook for where we are now at in the housing market and where you see us most likely headed over the next period of time?
So in complete candor, I bought a house I'm under contract on a house here in Naples, Florida. I think it's an absolutely stupid thing to do from a financial standpoint, but it's not all about math in this world. Everything is not a financial decision. Sometimes you do things for your family that is not the best for your long-term pocketbook. So I did buy a house. My prediction is that home prices will be about 20% lower year over year from the summer of 22 to summer of 23. I think home prices could drop 20% nationally. All-time record high home price appreciation, all-time record home price to income ratios. The Fed is going to be at least winding down or selling some combination of $2.7 trillion in mortgage-backed securities. Mortgage rates are going to shoot much higher. So I'm bearish on mortgage debt, junk debt, corporate bonds, and I'm starting to become bullish on sovereign bonds because I think there's going to be a big plunge in economic growth, which will become manifest in the next few months. Even to Brian Moynihan. I mean, you could take your advice from me or Brian Moynihan, the CEO of a very big bank, who tells everybody how powerfully strong the economy and consumers are. Well, if that was the case, Mr. Moynihan, I would ask them, why are consumers piling on credit card debt at a record pace? I mean, the increase between January and February was $18 billion in revolving credit. This is the second biggest increase in revolving credit on record. Well, why would a healthy consumer pile on credit card debt, Dunnigan? They wouldn't do that, especially when, those interest rates are, talk about, usury. Those rates are, Shylock rates. So, I would more listen to someone who has, an absence of an agenda. Because if Brian Moynihan comes on CNBC and tells you that the economy is in trouble and our consumers are in deep hurt, it's only because he needs the Fed to save his plunging assets. Okay, loans outstanding to the consumer. And if you're going to wait for that, it's going to be way too late.
There's another set of questions around people looking at their existing assets and their retirement funds. And I want to stress what we have, as always on this channel, we're not giving individualized investment advice. We're talking about principles that people should be educating themselves on, be aware of. So one question in two parts from Karen Walker: where is the safest place to keep retirement funds, even just a bit over 100K, and the best way to protect retirement funds?
Well, yes, as you say in your preamble disclosure, I don't know this client, a potential client, personally, so I can't recommend anything individually to her without doing my due diligence. However, having said that, I made my legal team very happy. You want to be diversified. If you're not in an actively managed strategy like my inflation, deflation, and economic cycle model, which is a wonderful place for the second best place is a diversified portfolio, which would include cash and precious metals in it. Don't just buy, stocks, because, people often misrepresent how good stocks are as a hedge against inflation. So from the nadir of inflation in 1972, which is about 2.75, all the way through 1980, which was the peak of inflation, around 15%, stocks lost 7% of their value in nominal terms. So it all depends on how strong inflation becomes. And I can make a cogent argument that after this next collapse comes and Jerome Powell is forced to rescue and reliquefy the banking system, even though inflation is still way above 2%, which is their target, you could have a very long and protracted period of stagflation, just like we had in the 70s, but much worse, with soaring yields. And that's a horrible place to, park your money, would be equities in that environment.
So during that kind of an environment, that's another thing that people are asking about is about what are the costs to the individual of sitting on cash? Your lies stop here says, is there going to be a time when you're heavily weighted in cash, maybe during a crash? And how do you deal with that and the fear of missing out?
Well, I mean, cash I've always thought of as a viable asset class. So, stocks, bonds, commodities, currencies, cash is a wonderful thing to hold because, here's the calculation. If the market's going to go down, regardless of the rate of inflation, let's just say inflation is running at 10% per annum. We have a choice. You have your investments, your investment bucket. You could either keep a high level of cash and then just subtract that rate of inflation from it, or you could suffer a steep loss in the principal and then subtract inflation from it. What do you think would be the smarter thing to do? Well, obviously, it would be to preserve your principal as best you can in nominal terms. So holding cash is a very good option, sometimes no matter how high inflation is, because your other alternatives just don't work.
There's a related question here, not about cash or stocks, but about annuities. And again, this is not personalized financial advice, but for general principles of people who are sitting on a large investment in annuities, Miranda says what to do with $500K invested in annuities. No penalty for withdrawal, pay taxes only. What are the trade-offs if I cash out this year and buy precious metals? What are the risks if I wait to cash out to the beginning of next year? Appreciate any thoughts on this comment.
Well, I mean, I don't know when this individual purchased her annuity, but it had to be some time ago because she's out of that penalty period, usually like a 9-year period of surrender charges. So she's past that. But if she bought it 9 years ago, and I can do that math quickly in my head, interest rates were very, very low. You're talking about, 2011. That's if she bought it then. I don't know for sure, 2011, 2012, 2013, sometime around. She's outside of that surrender charge. So I would imagine the yield, the promised dividend backed by the insurance company from this annuity is very, very low. And in real terms, it's negative. So if without knowing her, and I can't do my due diligence without knowing everything about her, but considering cashing in that annuity and diversifying is probably not a bad idea, looking into that option. In fact, I think it's a very good idea. At least evaluate your options.
You've talked to us about the trade-offs of whether and how much to have precious metals represented in your portfolio. And as an active money manager, you're not a perma bear on one thing and a perma bull on anything. You adjust your approach depending on what your leading indicators are telling you is likely to be the trend going forward. So can you give us an update on your latest allocation of precious metals in your model portfolio for your current clients, and if you have an expected direction that you think that will take over the next year?
It's a great question. So I did reach the maximum allocation to precious metals about a month or so ago. I'm now at 18 to 20%, which is my max exposure to the metals and mining sector. It had been working out very well for us outside of today. So I think bear market rallies or counter trend moves are very violent. So you're seeing a big up move in the markets today, sell off in gold and the miners. I still think we're in a big, long bull market. And I think it's just getting started. It will be, here's the caveat, it will be truncated for a very short period of time when and if we reach that liquidity crisis. At some point, maybe in the fall, is my best guess, whenever the Fed decides to really get going with their $1 trillion per annum of monetary destruction, draining the balance sheet, also known as quantitative tightening. When that gets going in earnest, in conjunction with rate hikes, as that slams into a very weak economy, the chances are very high, in the 90% or above, that we'll have a liquidity crisis. In other words, when the credit markets freeze, and then they just dump everything, and that includes gold. It's just a huge surge or a lurch towards U.S. dollars. Everybody wants them. Everybody needs them. So in that case, gold will sell off. but that'll only usher in the second leg. Let's call it the second leg of a multi-year bull market in precious metals, in my opinion, as the Fed ushers in that long period of stagflation like we've never seen before.
There's a broader question here about, and it's more of a personal reflection, if we could, from you on what we're all facing in terms of our futures. Tim Sandman says, Michael, in 10 years, where do you see the average person's living standards, better or worse, and why?
Very well phrased question. Living standards, standard of living. What is the standard of living? It's the increased purchasing power of the middle class. That's how I define it. The increasing value of your currency and an increase in productivity and an increase in your purchasing power because inflation has been vanquished. That's the reason why I put the cart before the horse. That is the reason why I think living standards are going to fall, because I see a big decline in productivity, and that protracted period of stagflation will erode consumers' purchasing power. That is the reason why I see people moving from the middle class, unfortunately, to the lower class. And by the way, the downfall of any great nation is the hollowing out of its middle class. And that is clearly where we were headed.
Now I'd like to turn the tide around here a little bit. Albert J. says, is all of the negativity regarding the current system inevitable? With so much negativity, can you provide anything positive to look forward to?
Well, there's so many things to. First of all, we just celebrated Easter, so that's something we all should be looking forward to. So, not to give you a sermon here, but to go back to economics, if the Fed were ever to allow this grand reconciliation of asset prices to occur, what a wonderful system we would have on the other side of it. We'd actually tie the monetary base to gold. So the mine supply of gold would equal the increase in the monetary base. And this is all fantasy, by the way. I'm hoping you asked me to fantasize on this. But I'm going to fantasize about a Federal Reserve that goes back to tying the dollar to specie. We have a very limited monetary base. Asset bubbles are no longer in existence. We don't resort towards universal basic income. We no longer monetize massive trillions of dollars of treasury debt. And we have a stable dollar, stable rate of inflation, low taxes, low interest rates. That is something that would be a product of going back to a gold standard. Something that I hate to say something nice about Russia, because there's nothing nice about what they're doing right now. But they are sort of returning that ruble to a currency that's backed by gold. And I think China might be going that way too. And this is going off of the U.S. dollar standard of trade. Dollar hegemony has caused a backlash because people don't want to be sanctioned anymore. Countries can no longer stand for that. So maybe we have a chance that just maybe, if we elect presidents that appoint Federal Reserve chairs that answer this question accurately and correctly. Do you believe that money should mean something? That the purchasing power of a dollar should be guaranteed by something other than a printing press? And that seems to me something that my 10-year-old daughter could answer correctly. But that would be a prerequisite to get a nomination through to become chairman of the Federal Reserve.
Well, we've got a lot of viewers and myself who are starting to understand what it means, what we've lost, frankly, that our great-grandparents knew and everyone before them about what real money was, and that money should preserve the life energy that you invested in it and carry that forward with you into the future and be your own private property to do it as you please in your own life, to give to your children, your grandchildren, that sort of thing, and should not be taken from you. So that's another aspect of real money that's been almost entirely lost on the current generation. I just had a client call me today and said when they talk with family members or good friends about, for example, silver and gold, they said it would be easier to be bringing up some really distasteful political topic or something religious that their people might not want to hear about or something. He says, when you start talking about this, they look at you like you're speaking a foreign language. People have lost understanding of what real money even is.
Well, it's all about control. And unfortunately, we have powers that be that just think that they can control markets and that people shouldn't have the final say. So that's when you end up with saying things like, we can never have a recession. We can never have a bear market. We need to adopt things like universal basic income and a central bank digital currency, because we, being that small elite group of people in the FOMC, or you pick the central bank heads of the world, the governments of the world and central bankers of the world are usurping your individual freedom, liberty, and decision-making powers, taking it from you. And that's why I come on your program, Donegan. Otherwise, look at your handsome face, of course. But other than that, not being facetious now, don't think I was being sarcastic. You serve a very real purpose here. I mean, these types of channels, these forums, are essential for people to at least think, why have I relinquished my right to have my dollars that I earned lose their purchasing power? Look at the monetary base, by the way. It has doubled. There's been a doubling of the monetary base in the last 2 years. So why have I allowed, who voted for that? Who allowed that to happen? Who sanctioned that? Who assented to have that power ceded from them? So, this is why I come on these programs, because I want people to question and not let it happen any longer. We can survive as a country and as a people, allowing the market, what is the market, by the way? It's millions of people having the right, the ability to decide what they want to buy and at what price. Everybody has that power to make millions and millions of decisions every day to decide what they want to buy, consume, build, and the cost of anything, the cost of money in the vanguard. So, let's hope you want to have hope. Let's hope enough people listen to Dunnigan Kaiser and Liberty in Finance, and we can maybe change the world one day. That's hope.
And we need to be sober in looking at that sometimes, and quite, I guess, some people claim every time throughout history, the examples that we see of that is wresting back individual power, individual freedom from the elite requires the willingness to sacrifice our lives and our sacred honor and our fortunes and that sort of thing along the way. It doesn't come for free. Yeah,
that's a sobering thought.
Michael, if people want to follow your work and find out how they can avail themselves of your professional management of their future, of their finances, how can they get plugged in?
So if you are a U.S. citizen, you have $100,000 to invest minimum, you can call the office at 732-772-9500. You can go to my website, which is pentoport.com. You can email me at mpento@pentoport.com, and we'll take you as a client and put you in the inflation, deflation, and economic cycle model. This way, hopefully, you can avoid these big drawdowns and even possibly profit from them. And if you don't have that, if you're not a U.S. citizen, if you don't have that money, you could always subscribe to my podcast. It's $50 a year. It's called the Midweek Reality Check. That's also found on the website. And there's lots of free things. There's latest commentary. There's some other things there you can enjoy. But the most important thing you can do is watch programs like this and make your own decisions. Don't do yourself a favor. Don't listen to CNBS and the rest of these people who tell you how wonderful everything is because the Fed has your back. They do not have your back. They are destroying your standard of living and eroding your purchasing power at a breakneck speed.
And unfortunately, many of the standard financial planners that people work with are not either self-educated enough because the official training they've gotten is just how to sell the company's products, packaged mutual funds and that sort of thing, or they're not free by their employer because they're not independent enough to be able to speak freely. We have been very grateful to have some independent-minded money managers who have educated their clients kind of outside of sort of extracurricular education they provided them outside of their standard brochures, and even forwarded them for precious metals further information because they aren't permitted by their employers to pass that information along directly. So there's a real burden that falls on the individual to educate themselves.
Yeah. I want to leave you with this one thought, if I may. I find it very ironic and very disgusting that the mainstream financial media, for the most part, ignores gold, which has been on record as displaying a way of preserving your purchasing power for thousands of years, but with alacrity trip over themselves to promote another product that supposedly does the same thing, known as Bitcoin and the rest of the cryptocurrencies. I mean, they trip over themselves, advertising, promoting that particular field, that asset class, and will not acknowledge precious metals, who actually has a proven track record of success. So you can probably answer that question for yourself as to why that is the case.
Well, Michael, we're just grateful for your presence here on behalf of all of our viewers. And folks, if you don't want to miss a single interview with Michael or any of our guests, make sure you subscribe for our free newsletter at libertyandfinance.com. Just put in your name, your email address, click submit, and then make sure that you respond to the confirmation email. That way you're opted in, and you'll receive an email in your inbox with every single one of our interviews so that you never miss a single one. And you can also go to our website, libertyandfinance.com. Right there on the homepage, you'll see a free downloadable PDF called The Golden Guide to Investing, just to give you some perspective on some of these historical facts that have proven themselves out throughout history that Michael's alluding to there. So, Michael Pento, founder of Pento Portfolio Strategies, thank you for joining us again here on Liberty and Finance.
My pleasure, Damian.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.